talk to the team, maybe throw it over to Chelsea to just do some brief intros before we get going.
Thank you, Jason, and good evening, everyone, and thank you for joining us. My name is Chelsea Ransom-Cooper. I am a certified financial planner and the Chief Financial Planning Officer here at Zenith Wealth Partners, and I'll kick it over to Marcus.
Thank you, Chelsea. Good evening, everyone. My name is Marcus Coleman. I'm a certified financial planner as well, but in my role as Zenith Wealth Partners, I focus on investment management, helping out with proposals and recommendations. Jason.
Thanks, Marcus. And Chelsea, we just want to pour one out for our teammate Famine, also a certified financial planner. She had a meeting come up with a client tonight, so she won't be joining us on the call, but she's doing great work. We'll be excited to have her on the next quarterly Marcus webinar. My name is Jason Ray. I lead our investment team here at Zenith. No certifications. They kind of keep me around because I'm the curious nonconformist who asks a lot of questions and tries to think about things differently, and hopefully that shows through in our content tonight.
So who are we here at Zenith Wealth Partners? And this always reminds us of the story of how Zenith Wealth Partners came to be. And it was through the mission and the vision to help people make smart and impactful financial decisions on their journey and pride themselves on being able to connect with people to receive that relatable financial advice. So that's exactly who we are. We're a team of experts, certified financial planners, financial advisors, investment advisors, and business advisory consultants who are all aligned with that mission to help our clients manage their money effectively. We are headquartered in New York and Philadelphia, and then also have offices in Boston, DC, and now New Orleans as well. So it's really inspiring to see a growing firm of other mission-aligned advisors who really want to help women and people of color build wealth.
Thank you, Chelsea. So in today's quarterly webinar, there's a ton of topics that we want to cover that are pretty relevant, and you're probably hearing a lot about in the news. We're going to talk about some tail and headwinds facing the market in 2024, some expected returns for asset classes, and how that influences our financial plans, as well as our asset allocation for investment portfolios. But the two main themes that really come to mind to most investors and most clients are monetary policy. So what is the Fed doing with interest rates, and also inflation? Is inflation still going to be around? Is inflation going down? How is this going to impact my budget, but also how is this going to impact my investments? And this tees up Chelsea well, because Chelsea and the financial planning team really have to focus on the monetary policy and inflation dynamics, because it drastically impacts their projections. Chelsea?
Yes, thank you, Marcus. And this is a common question that we receive is, how long do we think inflation is going to continuously be as high as it is, but also what is going on with interest rates? So keeping in mind that interest rates impact two different sides. So we're thinking about interest rates when it comes to our credit cards and we're taking out loans, but also interest rates when it comes to bonds and those high yield savings accounts that have been incredibly popular. So it's important to understand the maneuvers that the central bank has and how tightening or easing will shift the impact of those borrowing rates, bond yields, and overall the fixed income landscape. Then when it comes to inflation, which has grown exponentially over time, it's important to know what are the specific categories that can impact inflation, but then also understanding that even though we're trying to see inflation cool down, we're not hoping for deflation, which means that prices go back all the way back to where they were before, but we're hoping for modest growth when it comes to inflation, and ideally seeing some cool down in regard to housing and healthcare, which has really pushed up some of these costs.
Yeah, and as we think about some of these key themes and really taking these into account as we manage portfolios and really manage our client accounts and manage their money to help accomplish their goals and objectives, right? Global growth, productivity, innovation, sustainability, transition, I think are three key themes that have played out interestingly post-COVID. So global growth moderation, right? We've started to see different economies across the world have pretty significant variances in the way that they are generating economic output. And delivering returns through their equity markets or credit markets to investors. We think that as inflation and just policy across the world, not just here in the US, plays out, we're going to continue to see a lot of variance there, and we need to be really tactical as we allocate money internationally. Another thing that's come out of COVID and really kind of been at the forefront over the last year is just productivity innovation, right? As we think about global output, right, the way that the labor force is productive and how productive the labor force is in each country drives a lot of gross domestic product or economic returns for a country or for a segment or for the world. And there's been some significant innovations in productivity, right? AI is probably the biggest one, but people sleep on the innovations in healthcare that companies like Vertex Pharmaceuticals and other companies are making in the space to really innovate the way that patients are receiving care and are able to fight disease or extend life. And then lastly, sustainability transition has really played a role in how investors allocate money to energy. We were actually, Chelsea and I were in New York last week learning about carbon credits and like the way that carbon credits from the US government and from global governments impact the way that returns are had from investors from sustainable energy and other tactics from governments to really incentivize the use of sustainable energy sources. And I think all three of those are going to have a big role on how we think about and how you should think about managing your portfolio, managing your investments, looking ahead. And I'll kick it to Marcus for the last one.
Thank you, Jason. So the last key theme is geopolitical tensions and trade. So even as an investor, even if you don't have direct exposure internationally, we still have to be conscious of geopolitical tensions and trade because some of the largest companies in the US, give for example, Apple or Microsoft, they have global supply chains. So if we have issues in Ukraine and Russia, that was earlier this year, Hamas over in the Middle East, these geopolitical tensions potentially can lead to higher rates of inflation because the components that go into certain products might be exposed to that certain area. The other part of trade is we are in a global economy. However, during COVID, a trend that you have seen is more countries are trading in blocks. So trading with countries that have similar values. So this is something that we're constantly tracking to see how it impacts certain sectors, industries, and asset classes. So this leads us perfectly into policy, inflation, and outlook. So if you follow us on social media, a few weeks back, we made a post regarding inflation expectations and actual inflation. And the trend that we notice is most investors expect inflation to go down faster than historically it has done. So what does that mean? So right now, depending on what economists you follow or news source you follow, some people are saying there's going to be 6 interest rate cuts going into 2024. In reality, history has shown that inflation is usually a slower mover than expectations. So our expectations is inflation is going to be around, higher for longer, but by the end of 2024, you can see some rate cuts. And Jason, did you want to add into policy inflation and outlook and its impact on the global economy?
Yeah, I mean, I'll dive into it a little bit later on another slide, but I think the dynamic here with this chart is what actual inflation has been in dark blue versus what people expect and what the Federal Reserve target is. Like the difference there in 2021 and 22 and even 23 is pretty stark. And there's a lot of questions, and I think we internally still have questions about, are we going to get back to that Federal Reserve target, right? And if we don't, what does that mean for our monetary policy, which has impacts, as Chelsea mentioned earlier, on borrowing rates, mortgage rates, other things, right? Expected returns, everything that goes into as inputs to our financial plans and our investment policies, right? Are kind of driven by what we think expected inflation will be, not really actual inflation. So I think this is a great chart to show just like, do people ever expect inflation? I don't think so.
So that leads us right into global growth expectations. So since 2008, after the Great Recession, US large cap equities has been a strong performing asset class. And the correlation between US equities and international equities, they typically move in cycles. Right now, what we're seeing, the fundamentals are starting to switch to favor international exposure, but we have to be really focused on where we're given exposure to internationally. So for example, when we're looking at developed markets or on this chart, advanced economies, we're looking at economies that have exposure to artificial intelligence. We understand that this is a longer arc trend, and the countries that have exposure to that, we can expect their GDP to grow. Also on the emerging market side, that we're also following some longer arch trends. Larger arch trends such as semiconductor development. On this chart, you don't see Taiwan here, but Taiwan is one of those emerging market countries that are really leading us at the vanguard when it comes to semiconductors and chip manufacturing for smartphones. The last thing when you're looking at emerging markets, China falls into emerging markets. And China is a country that we are being very conscious of having exposure to because they have a lot of significant headwinds. They have a real estate bubble over there. They have a lack of transparency that really impacts investors because when you invest in a public market, transparency is everything. And the last thing that goes to global growth expectations, it leads to expectations regarding inflation rate in America. Why is this important? The inflation rate in America has a direct correlation to the value of the dollar. The dollar most debt internationally is dollar denominated. So if we believe that the dollar is going to go down with inflation, servicing debt for international countries is going to be a lot easier going forward, so which we believe will lead to growth internationally.
Yeah, and just to chime in here too, I mean, I think that you brought up an interesting point, Marcus, relating to like like Taiwan, right? And kind of like we got this data set from the International Monetary Fund relating to this global growth, and you guys can see in the column here on the right, 2024 is what we expect versus 22 and 23 are already realized. The International Monetary Fund doesn't recognize Taiwan as its own country, right? And we kind of understand that Taiwan and China have dynamics relating to whether or not Taiwan's its own country. So if you break Taiwan out of this China's growth looks a lot different, and Taiwan as its own standalone country really has high growth and is contributing to the world economy in a different way than China is. And in my career, I think we've really seen a dominance of U.S. equities, right? I've been in the business for just over 10 years, and U.S. equities since the Great Recession have really dominated returns. But as we look at dollar strength today, it's the strongest it's been in that period. And looking ahead, I think we could see some really attractive returns and return opportunities here internationally. Would be curious, Chelsea, just in your experience as an advisor and working with clients, how important is that international allocation?
It's really important, and it reminds me of in 2017, where we really saw international markets outperform, because I think there's a lot of an assumption that the US stock market will always outperform other economies. And majority of the time, that is a safe assumption, but that isn't the case all the time. So it is important to have a properly diversified portfolio so you can have that broad market exposure, because there will be those years where the US is not the dominant economy and it's not performing the best. And that could hinder you reaching your financial goals if you don't have exposure to those other economies as well. So that's something that we really keep in mind when we're creating that diversified portfolio. We want to understand your risk tolerance, but we also want to make sure that you're properly allocated across each sector, each economy, and then each asset class as well.
And that, Chelsea, that leads us perfectly into the next slide regarding tailwinds and headwinds facing the market. And Jason?
Yeah, I mean, look, I love this slide. I think the team is tired of me talking about like actual inflation versus expected inflation. I hinted at it a little on the slide before, but the way that people respond to what they think prices are going to be versus what prices actually are is really the core driver of how consumers spend money and how like our economy is driven. The Federal Reserve put out a paper. They put out multiple papers, but they put out one recently about like how inflation expectations are more important than actual inflation numbers. And they make their policy decision based on inflation numbers. But inflation expectations are really what drives the economy. As we think about like in our work with institutions, right, we set the investment policy statement based on, you know, what an organization wants to spend, right? And say like, all right, we're going to give out 7% in grants of our portfolio this year because our grantees need this money. If inflation goes up and everybody thinks inflation is going to go up, we saw institutions last year say, all right, well, we need to give away 8% instead of 7 because our grantees have more costs. Same thing on the planning side, right? Like we talk to individuals and families. They say, well, you know, mortgages are at 7% now. My grocery bill is 50% higher. How should we address that in our plan, and how should that influence like our decisions over the next year?
Mm-hmm.
And I think like this is really huge in how we operate as an economy. And yeah, Chelsea, just interested in like your perspective here on like how people actually act with this information.
Yeah, so of course it's the top of the year. So there's also a lot of opportunity for reflection. So it's interesting to see that even sometimes the spending plans and the cash flow plans that we like to set at the top of the year before may not necessarily be relevant, right? Because that grocery budget that we implemented of, you know, $300 or $400, but actually reflecting on how much groceries are because of inflation and continue to increase, it may not necessarily be relevant. So then we have to make those adjustments to see, okay, what makes the most sense to make sure that their spending is efficient, but also thinking about purchasing a home. Luckily, interest rates right now for homes have come down a little bit, but they're still in the mid to low sixes. Ideally, they'll get closer to the 5%, but you're not necessarily picking a house just based on interest rates, right? You want to make sure you have enough saved for a down payment. You want to make sure that that monthly payment is something that you can afford. And that should really help with your decision, because the best time to buy a home is if it makes sense for you. Not necessarily if interest rates are X number or they've dropped this amount. But if you see a home that you like and it makes a lot of sense and you can afford the monthly payments and you have enough that's for the down payment, then that is a right time. And you understanding that interest rates will always continue to evolve, so you can adjust it there as well. So really what we're doing is trying to stay on top of what at least the initial prices are for their financial plan and making sure that we have enough for those down payments to get started, and then continuing to pivot and evolve the plan as it makes sense.
Thank you, Chelsea.
Well said. And you know, just want to take a quick pause there. Any thoughts or questions? I don't think we level set at the beginning, but feel free to come off mute or throw your questions in the chat if you have thoughts or questions on like these topics. We're happy to address anything that comes up. I think this is a big topic, so if folks want to opine on this or ask any questions, please do.
So we do have a question here. So it says, considering that inflation is expected to go down, what sectors do you see primarily benefiting from this?
Great question. Thank you, Romy. I think that, like we mentioned in the beginning, one, on this slide, people don't ever really expect inflation, right? And this chart that you see on the screen is like market participants and consumers. So like people like you and I who like are spending our money, or institutions who are spending our money on goods, right? We don't think prices are going to rise, right? We think they're going to go up 2%. When they historically the last 2 years have been going up 7%. So I appreciate the question, and it's hard to tell and predict what sectors are going to do well. But I guess like if I had a crystal ball, which I don't, but it's hidden in the back, so I might. when inflation goes down and the Federal Reserve gets inflation closer to its target, so we showed that chart of like actual inflation versus expected versus Federal Reserve target. When it gets to that target, the Federal Reserve is going to say, okay, well, our high interest rates that we've raised rates up to, mortgage rates at 7%, SBA loans at 12%, all these things, everything's high rate on the short duration. Now we need to lower rates because inflation's higher, and we don't want to slow the economy with our rate policy. When the Fed lowers rates, we really start to see a benefit to long duration asset classes. And what I mean by that are investments that have their earnings or income way out in the future versus in the short term. So those sectors tend to be technology. Those sectors tend to be long duration bonds. Those sectors tend to be like innovative healthcare, consumer discretionary. So think about things like Target, and things that people don't necessarily need to spend their money on, but want to. Tend to be the sectors that benefit from like lowering inflation and accommodative Federal Reserve policy. So we always maintain diversified portfolios for our clients at Zenith, but we do take tactical approaches to say, okay, well, we should be overweight or underweight these particular asset classes or sectors. I think as you've seen some themes, and we're going to talk about this a little bit later, but since you asked the question, right, we want to make sure that we've got exposure to international equities, right? And that's big. And we want to make sure that we are thinking and being mindful of the duration in our portfolio, both on the equities and the credit side. So do we have 6-month treasury bonds or do we have 30-year treasury bonds, right? Because the 30 years long duration, 6 months short. And do we have industrials equities or do we have technology, right? Industrials is shorter duration, technology is longer duration. Making sure that we're pairing those durations appropriately is really critical to make sure that we benefit from a lowering inflation, kind of like moderating inflation, lower central bank policy is really critical.
So what I heard was pairing, being intentional, looking at short duration versus long duration, and being intentional about what we're selecting as longer duration, and looking at exposure to those diverse economies or international developed markets.
That's it, Chelsea. But as you mentioned in the beginning, we are money managers that help our clients achieve their goals and objectives, right? So like if your goals and objectives are shorter duration, then we'll never invest your portfolio in something that is long duration focused, right? So like you got to be mindful. Yes, we think that this is a portfolio theme that's going to play out. But if you're telling me like, hey, I want to buy this house in 2 years, or I want to spend down my money in 5 years, right? Like what should I invest in on those two goals? We're probably not going to introduce a long duration bond, right? We're not going to introduce overweight technology. We're going to make sure that the duration is aligned with your goals. So I think it also, not only what are you going to benefit from, but what are your objectives as well to make sure we match those appropriately. That's a great question though.
And I feel like that question really leads us into a core part of our process when it comes to investment management and financial planning. It's coming up with our long-term capital market assumptions for major asset classes. How we come up with this is not something Zenith is doing behind the scenes. We partner with the major investment banks like JP Morgan, Goldman Sachs. Every year they produce long-term capital market assumptions based off of their views on a macro level and also on a technical level of how these asset classes are going to perform. We come to a consensus at Zenith after reading all these reports, and we say, okay, this is what we believe how these asset classes are going to perform over a full market cycle. And how does this influence the investment management side? So our whole focus, and Jason touched on it, is customization. The client's goals, risk tolerance, how do we build out an attractive risk-adjusted return portfolio that aligns to our client? On the financial planning side, one of the big things is retirement. Clients are on fixed income. What is the appropriate asset allocation that ensures this client can maintain their way of living in retirement while keeping up with inflation. And Chelsea and Jason really focus on our institutional clients. Chelsea really does a deep dive financial planning for our retail clients. Can you two provide insight into how these expected returns goes into investment management as well as financial planning?
Yeah, I can kick it off. So this is really important, especially when we're revisiting and having our investment reviews with clients, because there's two rates that are really important for the success of a financial plan. It's your savings rate and your rate of return, right? Because those are the two components that can help with compounded growth and helping you achieve and grow your portfolio to the numbers that you're hoping. So your savings rate is something that we can control through our own accountability and discipline. But then what is the rate of return that we need? But then what is the level that we're taking on in comparison to the risk that we're comfortable with is super important. Because of course you can see some of these where it's like private equity or real assets or other high yielding bonds that could have a higher level of risk. But do you actually need to take on that level of risk for the success of your plan? If you don't need to, then why? And that's something that's really important when we're creating our financial plans, is to understand what is the rate of return and what is the growth that you need so that your plan will be successful. And then what is the least amount, right? So then we create our diversified portfolio around that. So you're not taking on more risk than you need to, and not seeing an opportunity for your portfolio to really have a lot of choppy experiences. Like if you don't need to have a lot of up and down and a lot of volatility, why put yourself in that position? So we like to make sure that we have a properly diversified portfolio that is meeting a consistent annualized rate of return that will help you achieve your goals. Jason, I'll kick it over to you on how we do this with our institutions.
Yeah, look, I think that's so well said, Chelsea. And like, it's all about, right? We talked about our work to manage our clients' money to achieve their goals and objectives. Doesn't matter the segment, right? Like creating that plan, creating that policy is the starting point for how we allocate money and think about these expected returns for clients. Whether it's retiring or whether it's buying a home, right? Or whether it's a certain spend rate, we want to give away this, rate of our endowment and grants. Understanding that spend rate and the inflation rate, and then contextualizing that on the backdrop of what we expect the next go forward market returns to be. These returns on screen represent like what we expect the next 8 to 10 years to look like over a full market cycle for these asset classes. Obviously, there's liquidity considerations with each one of these asset classes, right? US equities are the most liquid. Private equity is probably the least liquid. And you get your illiquidity premium based on whatever asset class you're in. But making sure you understand that required rate of return, whether or not that's based on, spend rate and inflation or a retirement plan, this is how we contextualize and say, hey, this is your spend rate, this is your inflation rate, here's what we expect inflation to be moving forward, and here's what we expect each asset class to perform moving forward. So based on that, here's the asset allocation that we're suggesting to your group to make sure that you hit your goals with certainty, right? We're not certain about these asset class returns, but what we are certain on is your goals. To say, all right, well, we want to give away this. We know inflation's going to be this. We can't have an asset allocation with 100% fixed income if we have a 6% spend rate and we think inflation's going to be 2% long term. So understanding what these expected annual returns are and making sure that we're leveraging the firms and the banks that have the data to put out these expected returns and consolidating those into a consensus view is what we've done here to make sure we're informing our plans and our policies with the right information to be able to set the right asset allocation to hit those required returns is really critical. So I'm proud of the team for putting this together. I think it speaks to our recent partnerships with BlackRock and JP Morgan to really understand this data and conceptualize it and put it together to say like, hey, here's what we expect looking ahead, and making sure that we're setting the right asset allocation with our clients to achieve their goals. So well said, Chelsea, and I couldn't agree more. And I don't think it's segmented. I think it's just the way we talk about how we work with different clients to put this into place.
And that leads us into the value of diversification. And this chart here can seem like a whole bunch of scribbly lines, but I really want you to focus on the top line that's red. That's the S&P 500. So most of us, when you're new to investing, you probably heard from someone, all right, if you don't know anything about the stock market, invest in the S&P 500, usually a sound investment. The reason why, over a 40-year time horizon, the S&P 500 has an annualized return of 9 to 10%, right? But however, that isn't always the best performing asset class. That's the value of diversification. So if you look at the white line, that's private equity. Private equity is an alternative investment. A lot of clients, if you're new to investing, you might not have exposure to, but institutional clients typically have exposure to private equity. And you're seeing here, there's been periods from 2019 to 2023. The S&P 500 really has been the strongest asset class. But recently, if you look at 2023 to 2025, you see private equity, an alternative investment class that's providing great returns. This is the value of diversification, not just looking in the public market, your typical stocks and bonds, but also looking at alternative investments, a very large space that has private credit and private equity. These asset classes can really lead to generating attractive risk-adjusted returns compared to a benchmark. Jason or Chelsea want to chime in on this slide?
Well, I think this also just speaks to like, one, diversified portfolios are important, right? And I think that'll be the theme of this whole presentation. But when you look at the difference between like the US Treasury there in green versus like private equity or the S&P 500, for example, the range of expected outcomes is so much wider as you go up the chart, right? So the S&P 500, you can see the fluctuations over time, right? And like that is something to consider as you think about your objectives. If you have a short-term goal, US Treasuries and the US aggregate bond may not be the worst option. They're probably the best option because they provide a certainty and a tight range of expected outcomes versus as you go longer on the curve and you say, oh, well, my goal or my objective is 10, 20, 30 years out there. While you have more certainty in the short term with those asset classes, long term, you know you're going to lose and miss out on returns, but you won't have to deal with the volatility. So I think that's really critical. Like as these lines go further to the right, they get more fluctuated and they get more up and down. And I think that's really emblematic of like, okay, well, I want to buy a house in a year. Oh, well, I want to give away 15% next year. Oh, but over the long term, I want to give away 4%. Or like over the long term, I want to retire. Those goals look totally different. And I think as we allocate money, this chart, I think, does a great job. They are squiggly lines, to your point, Marcus. But I think they do a great job of saying like, look, this is kind of like how much volatility you're going to deal with to hit your long-term goals versus your short-term goals.
So this slide here, portfolio management themes, is we just wanted to bring this to our clients' attention, but also if you're joining us for the first time, this is a great chart to really look at the performance of asset classes over time. So this chart goes back to 2004 up to recent time of 2023, and really comparing from large cap all the way down to small cap. And what you see here is this green line is small cap value. The reason why I want you to focus on the green line small cap value, we talked about this earlier in the presentation. This purple line is large cap growth. Large cap growth was the best performing asset class in 2023. Really driven by the seven, we call the Magnificent Seven, these mega cap companies, but also large cap equities have been one of the best performing asset classes over the past decade. However, if you would have started back in 2004, the best performing asset class for you, if you're looking at returns, if you'd have been invested in small cap value. The reason why we're showing this is the value of diversification. Last year asset class performance does not mean that asset class is going to perform the same going into next year. That leads to one of our talking points we touched on about increasing international exposure. International equities weren't the best performing asset class in 2022, 2021, or 2020. But now the fundamentals are shifting to say, okay, let's increase exposure to this asset class. So it's important for us to really look at historical performance of an asset class compared to recent performance to make sure that we don't fall into recency bias, where we go, okay, U.S. large cap performed great last year, let's do the same thing for 2024. A lot of times if you fall into that bias, that's where you don't see the best returns from your portfolio.
Yeah, I think this is a great chart. And welcome Chelsea's perspective here, but I think small cap value is a very volatile. You can see the swings up and down in that asset class kind of since we started this analysis here on the screen, and have had clients allocated to this kind of, on and off throughout my career. And, I think it's hard to stay put, right? You see kind of the drawdown in 2020. I think this kind of speaks to the point of a diversified portfolio and why we don't allocate 10, 20, 30% small cap value, right? Because it's wildly volatile as compared to other equities. But again, go into the objectives, what your time horizon is and what your risk tolerance is. Are you willing to accept that in order to generate higher returns? I think is a really critical component. That's where we can add value as being a behavioral, kind of advisor on your side to say, hey, look, we knew it was going to be volatile. You want 15% a year. This is what you got to deal with, but it's hard to do.
Yeah, and Jason, what I would just add to that is I think also the probability that somebody would actually sit through one of these small cap value and small cap growths looks like we have about 24 to 25 years on this chart is very, very low. I had an old advisor colleague who always said, if you were going to allocate majority to small cap, be prepared to lose your shirt. And just because of the volatility that you could potentially experience, it's really tough to sit there and watch the account really go through a lot of those ebbs and flows or squiggly lines, as we've been mentioning before. So I think that's where it goes down to your risk tolerance, but also what do you necessarily need? So keeping that in mind and not overextending yourself, the hope and the potential for higher returns.
Well said. So key investment themes. So self-driving, EV, and technology are big drivers to the economy, not just domestically in the US, but actually globally. So looking at technology, going from wireless communication, smartphones, artificial intelligence, that space there, or biotechnology, the technology sector is going to be a big driver of GDP, not just in the United States, but as well around the globe. Also, self-driving vehicles. Self-driving vehicles are on the same level, and I'm tied up to global clean energy. But self-driving vehicles really have picked up significantly. I'm only 30 years old, and I have seen in the last 5 years the technology development of self-driving cars go from, we're probably never going to see anyone driving on the highway falling asleep, to now you see in the news almost every day someone behind a Tesla, completely eyes closed, driving to work. So we want to have exposure to some of these long arching themes, such as self-driving, EV, and technology, but also global clean energy. So you have the Paris Climate Accord that has a goal by 2050 for G7 countries to be net zero, carbon net zero, which is big. And we're seeing that even in the United States, you're seeing a lot of investment into clean energy, whether it's wind, whether it's hydrogen, all these different investments into clean energy and the commitment from the G7 countries We want to have exposure to that long arching trend. And then the last part is MSCI emerging markets. We touched on it. Taiwan is a perfect example of emerging market country that has exposure to semiconductor chip development, which is a big part of our new economy as we move more towards technology being part of every aspect of our life. Having exposure to emerging market countries that are building the components of that goes into self-driving, electric vehicles in the technology sector is going to be big for portfolios over a full market cycle. So that leads us into opportunities for alpha in investing. Alpha, the term is just the outperformance compared to the market. The four main themes is selecting emerging market investments. We talked about it. India is another example, great for engineering. This country is the #1 producers of engineers in the world. South Africa, another example of great for commodities. South Africa, rare earth goes into chip development. The next part is sector-specific opportunities. We talked about it, healthcare, technology, sustainable energy, technology being one of the best performing asset classes, really driven by artificial intelligence. Healthcare, BP1 drugs. BP1 drugs are for obesity, overweight. Those are really leading the charge. And then sustainable energy. That is big when it comes, like I touched on, wind energy. Green energy is really something that's going to be invested in America. We're seeing it right now with the current administration, really investing in a lot of green energy tax credits. And for the last 2 points, I definitely want to bring in Jason or Chelsea for regarding value investing in overlooked sectors and innovative investment strategies.
Sure. Well, look, I know we're coming on time here, but I think as we look at sectors, we talked about it, thinking about technology, long duration investors, thinking about technology, sustainable energy, healthcare, innovative healthcare, I think offer promising opportunities for like long-term, attractive alpha generating returns. And then also looking at things like financials and real estate, right? We're looking at a different rate environment. We're looking at higher rates that, you know, in my own personal opinion, maybe not the firm's opinion, Jerome Powell seems to be like very focused on his legacy. He doesn't want to be a Federal Reserve chair who gets overtaken by inflation. So he's going to keep rates higher for longer. And I think these sectors in financials and real estate will benefit from that. So I think like looking at that in the shorter term, next year or two, could be really interesting. And then we talked about it, but AI and machine learning, right? Like, how do we invest in things that are improving productivity and improving productivity in the labor force, really adding to output? Look at Microsoft today or yesterday, hit 3 trillion in market cap. Why? Because they are integrating not only their business tools and their cloud computing, but also integrating AI into their process. Like the next Excel that comes out is going to be AI, compatible, and is going to have things that are related to AI that allow you to prompt their existing tools and allow you to really create things based on another brain that's not yours, but is machine, and allows you to prompt them to say like, all right, I want to create X, Y, Z. So I think making sure we have exposure to that AI and machine learning and have the next phase of technology is important. But I think that really speaks to some of the key themes and takeaways that we have from this meeting.
And here are the key takeaways. We did cover a lot today. Thank you for joining us. But here are some of the topics that we want you to really think about going forward into 2024. So market expectations regarding inflation. We believe that we're at the tail end of inflation. The Fed has gave guidance that they're going to take a more dovish stance. We don't anticipate 6 rate cuts, but we do anticipate at least 1 or 2 rate cuts in 2024. The global economy, we feel like the global economy, developed markets and emerging markets are positioned well. We want to increase our exposure to international equities, as we believe that they will generate some attractive risk-adjusted returns. Another thing is our expected returns are the highest in early stage companies. We touched on one slide, we talk about private equities. So having exposure to small cap investing, or if you're institutional or an accredited investor, exposure to private equity opportunities could be a way for you to build out a diversified portfolio, but as well as generate, once again, attractive risk-adjusted returns. The last two points, Jason really touched on it. It's about investing in long duration, not just on the fixed income side, but long duration equities. I think that was a very valuable point because in investing, we talk about long duration fixed income and bonds a lot, but never really talk about long duration equities and how that could be positioned in your portfolio. And then the last part is what sectors we think are going to lead the charge. And the three main sectors are healthcare, technology, and sustainability. Really sustainability when it comes to energy. Those investments, and we touched on it, there's some headwinds there when you come to current administration with green tax credits, but also globally with the Paris Climate Accord that the major countries are committing to invest in green energy. So once again, thank you all for joining us for our quarterly webinar. We are going to open it up. If anyone has any questions, you can raise your hand via the Zoom or drop it in the Slack. Let me drop it in the chat.
And we are a little tight on time as well. So we'll take 2 questions. If anyone wants to come off mute, other than that, I can read some of the questions we've received.
Appreciate it, Gloria. You're a repeat offender too. We didn't call you out in the beginning, but thanks for joining.
All right. I'll read this one question. I think this is a great place to kind of end it. So out of the 3 of us, how do you foresee the upcoming elections influencing economic policy and market dynamics in 2024? I will let Marcus kick us off.
So it's a great question. And it's funny that Chelsea kicked it off to me because I was reviewing some articles on the trends on the election cycle. So going into an election year, the fourth year, typically you won't see major monetary policy changes because you want the economy in a position of strength to help the current administration get reelected. To answer your question directly, what do we think about equities? We still think U.S. equities are positioned to perform well, but the performance will be muted compared to 2023. That's what historically states in election cycles. The fourth year is typically strong performance, but muted compared to the previous years.
I think it's a good question. Look, you guys, you continue to ask us to bring out our crystal ball, which, like I said, I have in the back, but I'm not going to pull it out on the call. It's a good question. I mean, if we could predict Federal Reserve policy based on cycles in the world and economy, we wouldn't be here managing your money. Like, we'd already be rich. Like, I think that there's a clear dynamic between policy and like the election cycle. I think, to Marcus's point, the data will try to draw us into correlations that seem obvious, but I want to take a step back and acknowledge that they're probably not as obvious as we think. I do believe that we are dealing with personalities more than we think we're dealing with data. So I alluded to the fact that Jerome Powell has a personality. He is a human. He's not a computer. So like his legacy as a policymaker, like think about Ben Bernanke and like past Federal Reserve chairs who have these legacies of saving the economy because of their policy. he seems like somebody who cares about his legacy. So I want to make sure we contextualize, like, okay, well, what in the face of strife or election or continued inflation, what will somebody who's concerned about their legacy do? And I continue to come back to the point, if we're thinking about like the game theory and him maximizing his legacy, he's gonna keep rates higher for longer. He will not lower rates to stimulate a higher equity returns or to try to influence more borrowing. He's going to kick inflation out when he can. So I think that that is really something to consider. That's, again, personal view. The firm, we have a view. We showed our capital market assumptions, expected returns. But I think we're really dealing with an ego here in our Federal Reserve that wants to kick inflation out while he can. And we see higher rates. People all think rates are going to go down. I think we're going to get surprised.
Thank you guys for your thoughts. And that, I think this is a great segue then. So if you have more questions and you want to hear more about our thoughts, or even have us just take a look at your portfolio, if you're not a client of Zenith, if you are a client of Zenith and you'd like to have this as part of your annual review, please reach out to us and we'll make sure that we get some time on the calendar. But want to say thank you very much for everyone for attending this webinar, and we'll make sure we send out a link so you can start to RSVP for our next one next quarter. We do these every single quarter. So January, April, July, and October, and we look forward to seeing you again.